Welcome to Next Matters Most, a podcast on the future of business, entrepreneurship, and technology. I'm your host, Nick Jordan, and I'm here with David Morris and Patrick Lineberry, both of which are attorneys. Well, they're many things, including, but not limited to, attorneys with the Forrest firm, which is I'll let you guys tell it, but as I know it, it's a statewide, so many different markets in North Carolina serving the business community. And you each have different areas of expertise and backgrounds, which I'll let you go into. But today, I specifically am looking forward to talking about opportunity zones and what that means as either an investor, but also as an entrepreneur, and how people might be able to take advantage of that in a kind of a win-win way on both sides of that coin. So I'll stop there. Patrick, your camera's on, so I'll give you first dibs. Give us your intro and elevator pitch about who you are and what you're working on.
Thanks, Nick. Thanks for having us on. Patrick Lineberry. I'm an attorney with the Forrest firm. I handle mainly commercial real estate transactions, and lately have been finding myself getting into the opportunity zone stuff. So we have done actually a lot of work with this and have advised clients on a lot having to do with opportunity zones, and looking forward to the conversation. I'm based out of Greensboro, wife, 3 kids. Hey guys.
They'll be in college by the time this podcast actually ships. I'm just kidding. No offense, shipping team. All right. Thanks, Patrick. David, what's up?
Yes, my name is David Morris, and I'm one of the managing attorneys with the Forrest firm. I work out of our Durham office. My primary focus in terms of practice is acquisitions, private equity and venture capital fund formation, debt and equity private placements. I've been with the firm for about 5 years now, going my 5th year now. And opportunity zones are something that Patrick and I have been working on for the past year. And have enjoyed the opportunity working with them on some of the transactions that we've closed thus far.
Cool. And you've also both given presentations, and so if there's any collateral that you've made public from any of your presentations, I'll make sure to post a link to that kind of in the show notes or whatever. Link in bio. So let's not spend a ton of time. We're going to hard stop it at an hour. I know everyone's got other business to do, but high level, what is an opportunity zone? How did it get created, and why? And let's start kind of from the beginning.
I'll start, Dave, and you can fill in where you deem necessary. But the Opportunity Zone legislation is a product of the Tax Cuts and Jobs Act passed by Congress in 2016. Basically incentivizes investors to put money into economically depressed areas. And these economically depressed areas are what we call opportunity zones. They are designated by the states and certified by the Treasury. And that's how we know where they are. You can find them by going to your municipality or your county's GIS. They usually have some updated maps showing where the opportunity zones are. So if you're looking at some property to buy or to invest in, or you're looking at a business to invest in, and you want to know if it's an opportunity zone, you just you need to find your municipality or county's GIS and see if they have maps updated for that. But anyways, that aside, the Opportunity Zone legislation designed to get investors to put money into economically depressed areas. And it offers investors 2 kind of tax advantages. One is on the front end of the investment, and one is on the back end of the investment. First of all, an investor who wants to realize the benefits of the Opportunity Zone legislation needs to have qualified capital gains. And there's a whole lot to kind of figuring out what that is, but for the moment, we'll just say capital gains need to be invested into the Opportunity Zone. And they get invested into the Opportunity Zone by being put into a qualified opportunity fund. So once they're put into the qualified opportunity fund, assuming that the opportunity fund maintains its status for the duration of the investment. A couple things happen. Once the gains go into the fund, the basis of the gains gets set to zero. If you hold those gains in the fund for at least 5 years, or at least until 12/31/2026, your basis in those gains gets stepped up from zero, gets a 10% step up in basis at this point. So at 12/31/2026, an investor is going to have what's called an inclusion event if they haven't sold off their investment already in the fund. And that inclusion event is basically when the taxpayer has to pay taxes on those capital gains that they invested. But if they've held those gains in the fund for at least 5 years, they'll have to pay taxes on 90% of what they would have had to pay otherwise if they did not invest the funds into the qualified opportunity fund. So assuming that the investor keeps the gains in the qualified opportunity fund for another 5 years or so, if overall the investor has those gains in the opportunity fund for at least 10 years, then when that investor goes to dispose of or sell his interests in the opportunity fund, then on that disposition, they don't have to pay any taxes on capital gains. So you have a front end benefit for capital gains taxes where you get a step up in basis, and you get to defer the taxes, the payment of the taxes until the latest 12/31/2026. And on the back end of the investment, you get to walk away from the opportunity fund tax-free in terms of capital gains.
Cool. Anything to add to that, David?
Yeah, I think one of the things that when people are considering whether to do a QOF investment, a qualified opportunity fund investment, as Patrick mentioned, one of the things if it relates to, is this more beneficial than doing a 1031 exchange, which also potentially involves real estate. The differences between the two is that for a 1031 exchange, you're really focused on just real property in terms of assets that can be dispossessed in order to take advantage of tax deferral. As opposed to with a qualified opportunity zone investment, it can be sale of any type of property. It could be real property, any tangible property, personal property, including stocks, as long as you're putting the gain from that into the investment. For a 1031 purpose, it has to be like kind real property. So under a qualified opportunity fund investment, there's no similar like kind reinvestment requirement. As it relates to a QF, it only relates to the gains, right? So, you don't get the benefit if you put in invest the original basis as you would under a 1031 exchange, where you could defer or reinvest the entire basis in capital gains and get that tax deferral benefit. As Patrick highlighted, this is specifically for opportunity zones you can find using a GIS, geographic information systems available with your local county or city, as opposed to a 1031 is any real property, basically anywhere in the United States. And in terms of deferred tax liability, it's specifically for qualified opportunity zone investments. It's really for the reduction or elimination of capital gain taxes. And as Patrick mentioned, that's dependent on the whole period. As opposed if we're doing a 1031, there's unlimited deferral of those capital gains invested in replacement property or substitute property.
That's awesome. Well, so I think while we stay on kind of the investor, how busy are you guys with opportunity zone investing and investor questions? Does it feel, so let me back up. I'm not a sophisticated, specific investor or tax advantage investor. I'm not a lawyer. I do invest in some startups. I'm in an entrepreneurial community. I am technically an investor in real estate through kind of my commercial property. And I'm always looking to be opportunistic. this sounds easy, simple in theory. Anecdotally, you want money to go into economically depressed areas. It's going to raise them up. It's sort of if you keep it in there, then you can get tax benefits on the gains, right? So it's like you can keep your own gains and not have to pay taxes, but you still have to put your money in and do the work so that there are gains and that the area does go up. It could go down. It's not without risk. So it's sort of trying to create that win-win, put risk in and be rewarded if that pays off. And the other win, not just, for the investor and the building or the property or the business, but also for that community. So like win, win, win. But when you describe it, it seems complicated, must be qualified proceeds. So not just basis, but like proceeds. Maybe there's a time window, then that has to be into a QOF, and then that QF has to deploy into a this. So not to rehash that because, we can read it, but is this type of program already like well subscribed, oversubscribed? Do you think there could be a benefit to, Opportunity Zone Fund for Dummies? How are you seeing the kind of the trends in the marketplace from the investor point of view?
I would say, Nick, that up until we get questions all the time. I would say, and we have been for the past, I guess, couple of years. I would say that after the Treasury regs were just finalized and promulgated late 2019, up until that point, people were a lot more hesitant to pull the trigger. We're starting to see a lot more people pull the trigger now on it. It is pretty complicated. One of the beauties though about it is that it is self-certifying. You don't have, unlike a 1031, as David was just talking about earlier, you don't have to have a qualified intermediary or something like that to hold the gains for the investment. It's a fund. It would be a qualified opportunity fund that really anybody can set up and self-certify to the IRS that they are. Now, obviously, there are reporting requirements, and you need to make sure if you're running an opportunity fund that you have really good accountants and really good record keeping. But it is kind of self-governing in a way, and so in that respect, it is easy. I mean, there are pretty complicated rules to 1031 exchanges as well. There's going to be complicated rules to any kind of tax advantaged program. Unfortunately, they're not. You need professionals to help you with them. But honestly, they can be as complicated or as simple as you want them to be. But yeah, there's a whole range of responses to the kind of the issue that you're posing there.
Anything to add to that, David?
No, I think Patrick outlined it pretty well. Thanks.
Yeah. So, I mean, I guess this is timely. In some ways, I wish these things were like published in real time because I'm like, oh man, it's so timely. Like Trump's tax returns are out. And this isn't a commentary either way. It's more like it's clear that with more sophistication, you get benefit from the government. And that doesn't seem to be like the spirit of this advantages. And we also have, independent of presidential stuff, fairness, equity, in all kinds of things. Like access to things bring up a big disparity in racial equity, gender equity, access to deals, access to information. So regardless of the president or all the sort of societal issues that we're plagued with right now, but this seems to kind of speak to that. It almost is another one of those, right? Where it's like, if you can get really complicated, call your local attorney for X amount of dollars per hour and talk it out with them and then work out a thing. And then you've got this and you can follow these steps. Then therefore you can now help improve an economically depressed neighborhood. Is there a way that opportunity zones can be more accessible for everyday people who might have had a gain? They sold something. I mean, could a local shop owner sell some stock, get some, have what would have normally been, capital gains and roll that into it and buy the store next to them? Is there a way that this money could be or this advantage, it's not money, that this advantage could be more easily accessed by the masses? First of all, do you have to be an accredited investor as defined by the SEC or whatever? Do you know if you do, Patrick?
Oh, you definitely don't have to be an accredited
Okay.
investor.
So that's one gate away. So anyone
Yeah.
because anyone can make a gain, right? You can sell your business.
Anybody can make a gain.
Buy a
That's
stock,
right.
Okay. And so
Yeah.
how
So,
hard
I
is
mean,
it for yeah, go ahead.
I'll say a couple things there. I completely.
That was a lot, but yeah.
No, it's good, man. I like it. You know, it's important to be critical of you know, where you are and make sure you're not being complacent with anything. I'll say that, you know, from my perspective, one of the reasons why, and I think this is borne out in the rules, I think one of the reasons why that this can be complicated is because Treasury does not want people to take advantage of this. So one of the rules that makes it kind of complicated is the fact that if you're buying tangible property, especially real property here, is what we're talking about, you have to substantially improve it within 30 months of acquiring it. And that substantial improvement piece means that you have to put into the property what you essentially, you know, your basis, essentially what you paid for it. So that's one of the complicating factors. I mean, they want you to get moving on this to spur on development in these zones. And as far as, you know, whether there is an easy way for the layman to kind of get into this, there are, you know, this is kind of where probably securities regulations and rules kind of do a dovetail with Treasury regulations, where you know, it really is it would be incumbent upon maybe an entrepreneur or somebody or a developer to set up a structure that is easily accessible to lay investors, so that they can then put their funds into the qualified opportunity fund. On the investor side, it's not that complicated. I mean, all you have to do is realize gains. On the opportunity fund side, that's where it kind of gets complicated, and that's where you kind of need professional help. But as far as anybody who wants to invest in these things, all they have to have is gains that they don't want to pay taxes on. They need to find an opportunity fund that they're comfortable with, and they need to put those gains that they've realized into the fund within 180 days of realizing those gains.
How findable are those funds?
There are lists out there. Obviously, the lists are not regulated. They're not compiled by governmental entities, I don't believe. There are lists out there you can Google, or my favorite new one is DuckDuckGoing. But you can search for them on the internet, and you can find them. If I guess maybe the catch-22 here is that if you can search for the fund and you could find it, then it's probably big enough where if you're a layman investor, you might not qualify as an investor for that kind of a fund. So the funds that you know, your average person are probably going to be able to take advantage of are really probably just going to be funds that are set up at a more local level and are probably not as publicized or as big as those. I can see it coming together if a community or a neighborhood, for instance, wanted to improve some of the property that they have and they live in their neighborhood, which is in an opportunity zone. It could be cost effective for a neighborhood, for instance, to form a fund like that and get all the neighbors to pool in.
Well, and David, you know this because you advise a lot of, you know, investors, investment managers, funds. You ran a fund for a while, as you mentioned. You know, marketing your fund is sort of a challenge because it's is this different though? Because you don't have to be an accredited investor. You could market a qualified opportunity zone. Like, is there a way for, yeah, I mean, we want to invest into Greensboro, into Durham, into Raleigh, or some area or part that's, important to us. We could market that investment opportunity more freely. Is that correct? Or do you want to speak to that given your kind of unique background?
Well, I would say, as you know, with a typical fund, as you know, you would need to be an accredited investor, and that means either you have substantial net worth, usually $1 million, excluding the the value of your private residence, or if you're making income, if you're married, filing jointly in excess of 300,000, or if you're individual, 200,000 or more. In terms of, Patrick is highlighted on opportunity zone property, but, you also can invest in opportunity zone businesses that are located within an opportunity zone track. And to me, I'm not 100% sure whether or not you have to be accredited in order to invest those kinds of businesses, if it would be required under a traditional fund for you to be accredited, if you would have to have that same type of accreditation to invest in a qualified opportunity zone business. What it does allow you to do is to have different assets, as previously mentioned, that can be deployed as capital for that fund. But in terms of marketing, you do want to make sure that you're in compliance with regulatory, with the regulatory statutes and requirements. And there's, this is fairly new, and we're starting to see some investments in this, particularly on the real estate side. Haven't seen a lot on the opportunity zone business side, directly invested in businesses. But I think that's, that will come into fruition as people get more acquainted and more comfortable with doing the real estate aspect. I think the natural outflow is we will see increase in the investments in QOZBs as well. But the great thing about this, it does open up the amount of capital that can be deployed in such investments, and it is I think it's going to be a good long-term source for economic development on a go-forward basis.
Nick, I'll just add, let me just add a couple of things there. With regard to the accredited investor question, I'll clarify that the Treasury doesn't require you to be an accredited investor to get the tax benefits. Whether securities requires you is a different question. Another thing is that I think I've heard it said this way: opportunity zone investments, or the legislation for opportunity zone investments, doesn't make a bad deal good, but it makes a good deal better. And so kind of maybe one way this plays out is, especially with developers who wouldn't otherwise be going into real property with opportunities that's in an opportunity zone, developing it, because that step up in basis can really sweeten the deal for investors who are not expecting rental or revenue from the property while the property is being developed. And again, they have the investor or the opportunity fund has a period of time in which they have to develop it. But that step up in basis can soften the blow for investors and make it attractive to invest in a developer who's developing in an opportunity zone.
I mean, if you had to put like a practical number, is there like a back of the napkin where like, oh, this deal was only going to be like 5% IRR, but because I stepped up in basis and I avoided that 20% capital gains, that's now spread out. Well, I guess that's spread out, so you don't just add 20 to the IRR. Right. But I mean, how does that equate?
So I mean, if let's just say you have $100,000 in gains, and you put that into a QOF. If you didn't put it into the QOF, it depends on. There are a number of questions as to how those gains would be taxed. If they're short-term gains, they're taxed as ordinary income. If they're long-term gains, then it depends on what the bracket is, your capital gains bracket is. But let's just say that your tax rate is 20% for capital gains for the year that you realize those gains. If you realized $100,000 in gains, you'd be paying $20,000 on that. If you put it into the qualified opportunity fund, then you're not paying taxes on those gains until at the latest 12/31/2026. Plus, if you keep the gains in the fund for 5 years, then you're paying 20% of 90,000 instead of 20% of 100,000. So I don't know off the top of my head what 20% of is $18,000, David, instead of $20,000.
That sounds about right.
Yeah. So it's 10%. You save 10%. Yeah, that's right. You save 10% on your tax bill by putting it into the opportunity fund.
And then but at some point the basis is like fully stepped up and you are paying no amount of taxes on that gain that you invested into the opportunity fund, right?
Right.
And then what about if there's gains on that investment? So say that 100 then became 120. If you wait to, exercise or cash out for a certain amount of years, I think it's 10 or something like that.
It's 10 years.
You just get $120,000. That's
right.
Okay. So, I mean, at some point we can get a complex calculator and say, hey, what did that boost? Like what's the incremental IRR improvement? Someone has to have calculated that. I don't know if you guys have that handy, but like if that's the case, there is sort of it doesn't make a terrible deal great, but it definitely, I'm just trying to get to kind of the order of magnitude. Does it make like a pretty break even deal really acceptable, or does it go even further and say, or basically is it a large swing or is it kind of just a small little icing on the cake swing?
I mean, on the front end of things, you're probably gonna the benefits, the tax benefits are tangible, but I think where you see the most potential for this being a really good thing for an investor is on the back end, because I think the idea with this is to obviously revitalize areas that are economically depressed. And, as we all know, Durham's a case in point. Once the ball gets rolling on revitalization, it can be a snowball. And obviously, I do want to be mindful of some of the consequences of revitalization, like gentrification, but at least from the investor standpoint, and the investors may want to take an approach where they look for funds that are really geared towards maintaining the quality of living for the inhabitants of the neighborhood and committed to the neighborhood itself. But at least from an investor standpoint, monetarily, on the back end, assuming all goes right, then the property that they put their money into could be tremendously valuable at the end of it.
Yep. That's great. I think, I will work on the math there and an infographic, because I think, we gave an example of, capital gains, so that's more like 20%. But what if you had a gain that was a shorter term trade or outcome and it's ordinary income? And so then you're looking at, 40%. Or 50%. So then, there's other assumptions. I mean, it's hard for this to be perfect, but, if there were the same, rate of return or same growth rate, between an opportunity zone investment and a non-opportunity zone investment, then the difference after 5 years is very material. The difference after 10 years is like super material.
It could be. Yeah. Very well could be.
I guess we have to test all the assumptions. Like, is the sort of appreciation of this area that's in an opportunity zone same, similar, or what's your delta there? Like, it doesn't have to be 3 to 5%. It could be 1. It could be 0. It could be maybe -1, and you still come out ahead. There's some math there, but
yeah, right, it's so new. I was just say it's so new that I'd be surprised. I'd be surprised if there's much in the way of economic data, analyzing these really thoroughly, but it's the conversation is definitely worth having.
And so, David, Patrick just touched on this. There's not much data yet, but is there the hope that there's going to be a correlation between my Siri just keeps picking me up. Actually, why did I just say Siri? Sorry. Is there hope that there's going to be a correlation between this policy and some metric? Like, what's the KPI of to determine if this was a successful program to roll out?
Well, one of the key things is utilization of the area of the land that has not historically been used for commercial or mixed-use projects. Another key determinant in terms of KPI will be jobs created, particularly as it relates to opportunity zone businesses. And I think there are some unique opportunities on that front that we've seen in order to get businesses situated within opportunity zone real estate development projects. In order to meet the job metric, which would be one of the major KPIs in order to judge whether or not this is successful or not. I think that particularly as investors seek to deploy capital, they're looking for more than just what you typically see with, if you buy stock or something like that. They want to see that it has impact within their local community, and that it also helps increase and enhance the tax base from a government perspective, that overall benefits the community and leads to underrepresented groups being able to participate as well. And we've seen funds that have targeted that as well, specifically. So I think that it provides an opportunity for creative structuring going forward as well.
So let's stay with that. And I think that's the other, hopeful outcome of conversations like this is, it'd be great if I'm out there being a business and someone just like came in and was like, you know what, I'm going to give you money. That typically doesn't happen. Usually it's up to the business owner or the entrepreneur to go find their sources of capital and to be able to sell their kind of unique and creative advantages. For businesses in an opportunity zone or looking to locate into one or just looking for, something, right? And as it relates to this kind of topic, how would they go about pitching or sourcing some of the capital that's looking at investing into qualified opportunity zone businesses, QOZBs?
I think this is one where it's important for you as a business owner to be out there and talking to all types of investors, right? Because ultimately they're the ones that are going to give you or expose you to the relationships where this could be a possible investment as a possible investment for your company, right? As Patrick said, you may be able to identify some funds through, through services, but I think locally, it's if you're talking to your accountant, if you're talking to your attorneys, they will have contacts who are engaged in this particular area. They will have contacts that they can refer you to so that you can have those conversations and so that you can necessarily understand what's required in order to be as a suitable investment for opportunity zones. If you're there are certain things that you must meet in terms if you're OZB in terms from a safe harbor test, right? A few things is that at least 50% of the services that you perform are done within the opportunity zone. And that could be based on hours, or at least 50% of the amount that you pay for services, or that those services that are performed by the employees are done within the opportunity zone. Or, other alternative option to qualify is that if all management and operational functions are located in the opportunity zone. So you're making sure that you're structured and that you meet one of these safe harbor tests in addition to some of the other indicia. To ensure that you qualify and will be an attractive investment as a OZB. Those are things that you definitely have discussions with your counsel as well as your accountant.
That's great. And Patrick, maybe I shouldn't ask you this because we had trouble with the math earlier, but, what is, uh, so, um, so like, because I hear that and that makes sense. But I've also, I've been like an entrepreneur for 20 plus years. And, I guess 20 years ago, I was still in college, but I had, small business and whatever, selling stuff to people that sometimes I delivered and sometimes the product failed. And I'm studying things, I'm reading all the time, I'm going to, I'm learning professionally. I went to, University of North Carolina. I was in their business school. Like, I know more than like the average bear, but like anytime it's like, oh, talk to your like lawyer and accountant, it's like, man, give me the anecdotal thing. Like there's so many, I think a lot of businesses do have a professional network like that, but a lot don't, or if they can't envision what it looks like, they might not be able to ascertain if it's a valuable pursuit of their time or of their money to engage with that team, if that's how their relationships are set up, or if they don't have a permanent person in place. I mean, my wife runs her business and she just sort of piggybacks off of sort of the relationships I have in my business, but her business does kind of a lot of revenue every year and it's a full-time professional company. Is the math compelling enough, for a business owner to really pursue this? And my first starting point there would be, what does it mean to the investor? Like, is this just, if you're investable from a venture capital, then you're investable from the OZB or, kind of fund, or can a, bakery get an investment? And because they might grow or have cash flow or even just the basis alone, like kind of, either of you sort of piece together either the math side or kind of the scaffolding of why a business and what types of business might even start looking and how they can start to formulate their pitch?
Yeah, so from the real estate perspective, I would say that what it comes down, like the first place to start is just to have a good broker who can run the numbers for you and tell you, is this a good deal or is it a bad deal? The broker is going to have their ears to the ground and they'll have a pulse on what the market is like. So they can probably opine as to the value of a deal, opportunity zone stuff put aside for the moment. They'll probably have a pretty good idea of whether something's worth investing the time and money. And again, go back to the kind of the Turner phrase, opportunity zone, legislation will not make a bad deal good, but it'll make a good deal great. So you want to find those good deals first. And you want somebody like a broker to be the first person of contact to start talking to you about that. That's what I would do, to be honest.
I guess from the opportunity zone business side, I guess, this could be an attractive, way to raise capital for businesses that have historically been locked out or had limited access to capital. Due to the additional incentive for a prospective investor, particularly for an investor that's really has a very low basis, but a high capital gain appreciation over the years. Let's say somebody who's bought stock that has appreciated tenfold, 10 down, and is looking to continue to defer that. And that's a natural partnership there because they definitely they have substantial capital that they can deploy into a QOF. And they're able to assist businesses that otherwise, whether it be minority groups, businesses run by women that have, as you know, Nick, have been underrepresented from a VC standpoint and traditionally lack access to those kind of markets. I think that, particularly if you're working with groups that are focusing on those types of entities, whether it be like SOAR with NCID that focus on women entrepreneurs, or if you're working with, companies that are working with like Backstage Capital that's looking to help founders of color grow their business and things of that sort. If that could be tied in in conjunction with what you see with traditional fund structures targeting those markets, I think there's a win-win solution there.
Yeah. And what about, and so even more specifically, I'm thinking, so about, that's actually, that's great information. So I want to make sure I state that. And I'm trying to think about what about the actual sort of Main Street USA businesses that are like a retail store, a restaurant, a brewery, hang a shingle literally in a storefront. And there's many others like that aren't having any of those types of conversations, or that many of them. Is there a way for them to kind of get started on understanding how being in an opportunity zone is valuable, so that they can have some tools to go out and leverage that to seek investment?
Yeah, I think that's important, and I think that's one thing. If they're their landlord should be helping them and let them know that they're in an opportunity zone, right? Because there are certain businesses that are located and that they're not aware of that. So it's making that they're aware of that, and that I think this is great for those what I would call a mom and pop businesses, as you described. That eventually will be cash flowing positive, but they're not on a high growth trajectory, as you would see within a tech or software company. So no, there are great opportunities for those types of businesses as well. And I think that will be having the ability from an investor standpoint to get the tax benefits that afforded through through an opportunity zone investments makes that more feasible. And they're willing, not necessarily willing, they're looking. These are typically what I would characterize as investments that generate singles and doubles, nice, good returns. But you're not necessarily looking for that 10x investment or 5x investment, but it allows you to generate, as an equity owner, if you're an equity owner, some distributions of cash, either through dividends or other cash distributions to you as an investor, but it also allows you to potentially get all the tax deferral benefits under the QOF structure, or Qualified Opportunity Zone structure. So, I think that's something worth exploring. And I think that what I think that can be seen is that there can be more activity on that front, targeting those types of businesses, right? But we've, Patrick, what's the fund that we came across that is actually trying to do something like that wants to establish a franchise? Do you remember?
Yeah, it's now that you asked me, I'm blanking on it. It's Galvanize.
And so, they're looking. So, Galvanize. They're looking specifically to identify property that they can redevelop that are located in opportunity zones, and they want to help folks that want to have a franchise with nationally brand restaurants or shops, help them establish that within those locations, and that's a strategy that can work. And so there are funds that are targeting those types of businesses specifically. So
that's interesting.
Again,
and so how would that? Go ahead.
So it's all taking advantage of the structure and the creative structure that's availability under the rules, Treasury rules going forward.
Yeah, I think Galvanize is about as close to a plug and play real estate QOF investment as you probably could find. They've identified their spots. They've identified their vendors and their franchisors. And I think they've done a good job of vetting their model.
Yeah. And so how, if you invest into a brand new business, your cost basis is already zero. So is there further benefits to investing into a qualified opportunity zone business if it's starting from scratch?
I don't think you still get the tax benefits that you would, whether it's an established business or.
Oh, because you of the step up, so you'd still
Yeah.
got it. And then, are there any? So small businesses are, and maybe a franchise is a little bit different, but if it's your mom and pop, I mean, they're illiquid for the most part. So are there any kind of benefits on like the cash flow or other, or is it like you have to hope that that mom and pop then sells their pizza shop or, um, local store in order to get that back end gain?
Well, typically most mom and pops are structured as, as a LLC or an S corp, right, which has passed through distributions to the owners, right. So if you're an investor or equity holder in that, you would receive the distributions on a pro rata basis based on your investor and as you're represented on the cap table, right. So you get that through the life of the investment. In addition to, the additional, upside is if there's a sale down the road or some kind of what we call recapitalization. If the business is generating strong cash flows to be able to get debt in order to buy out your equity, upon agreed on time, that also provides you a liquidity event too.
Got it. So more, it sounds like just more thinking and more resources going into the business side. I think, educationally too, not just, money flowing in, I think is needed and will be helpful, because I've got still a lot of questions and I don't know if they're easily answerable or not, but I'm just trying to think of the, small business, the mom and pop, like the liquidity issue, or, even to all those things, like that's hard if I was an individual investor and not a fund, or a small fund, like just trying to, get the advantage of the opportunity zone opportunity. Well, that was a little redundant. With, really trying to get to the, I guess that's the struggle. Trying to get to the intent of this whole program, right? So if all it does is like create sweet mega condos in depressed areas, then all those like shop owners now can't afford rent. So how do we, make sure we're creating the equal, if not greater incentives for the job creation and the businesses that are in there, and making it clear, like a clear cut. I mean, part of this is making it a clear path of, like low friction for the investor. So I can just anticipate some challenges, like, with the very small business, direct investment.
David, I think you and I have had some conversations early on with some folks in your network about, what they saw as a potential upside in terms of revitalizing opportunity zone areas, is as opposed to kind of weighing that against the potential for not achieving what the legislation was kind of touted to achieve. I don't know if you remember those conversations, if you have any further comment on that, but I think the gist of it was, it can be done well, but it's essentially set up so that you can do it in a way that is not really equitable and transparent and fair for everybody involved.
Yeah, I remember those conversations, Patrick, and that goes to intentionality, right? And knowing as an investor what you want to accomplish. And that particular investor group wanted to benefit the people that lived in that area, right? And so they didn't want to necessarily see gentrification occur, right? And the whole goal was to have projects where they could also get, do mixed use project where they could have housing for the folks that have historically lived there, as well as having commercial activity, so they could benefit as a community. And so it requires that level of intentionality, Nick. But there are going to be folks that are going to, use this as an opportunity to pursue a lot of the developments that you see going on in particularly like you see in downtown Durham, where you're going to see, the nice high-rise condos and things of that sort. People will play the rules, and and they'll more power to them, and we understand that. But the intention is, if you have that intentionality, and I could say from a seller standpoint, I had a seller who had a nice tract of land in Opportunity Zone, and they decided not to sell because they didn't want to see another one of those types of projects, and they wanted to see ultimately that the buyer that purchased the property had intentions of doing something that would benefit that particular area where the property was located. So,
yeah.
there's
Well,
always
but the
good and
meaningful,
bad.
I guess, yeah. I mean, I guess if it's sort of a slippery slope, because if being an opportunity zone increases your value, then the amount of meaningful redevelopment dollar amount goes up. And then once you put a certain amount in it, it just can't be what it was. You cross some threshold where now you're sort of a large project, so is that sort of an adverse snowball effect that's occurring?
Yes and yes. Yeah, and there are folks that are taking advantage of that, and but that's the how things generally play out. But there are also folks that are being very conscientious and making sure that it meets the spirit of what was intended under the regulations, and that is beneficial to the residents of the community.
Yeah. Well, and in my mind, or when I said that, I really didn't mean take advantage. I just meant like if something was worth 500,000, but now it's worth $1 million because it's in an opportunity zone, then you have to put $1 million into it. Now you've got a $2 million project, and now you have to up the rents because you've got a lot of capital invested. Even though it's going to be tax advantageous, you still have to generate a return on that total number, which was driven up because of the opportunity zone, which then was the total amount was driven up because of the meaningful, or the threshold of what defines kind of a redevelopment.
Yep. So. Yeah, sellers are going to bake that into the price, presumably.
So let's move to kind of a close. I guess closing thoughts on, where, I guess it sounds like we're in the early innings. Is this, well, I guess let me start by asking, is this set to expire, or is there anything like with presidential elections that will like kind of end this program? Or is it kind of in place for at least a certain amount of time? I guess let's speak to that before we kind of think too far ahead about the future of the Opportunity Zone program.
I don't think it's going anywhere for the foreseeable future. I mean, there's been some rumblings from different people in Congress about getting rid of it, but overall, I think it's going to stay put where it is. I don't think there's no expiration date. I mean, in the legislation itself, the only kind of deadline is that 12/31/2026 deadline, which is when if you invested gains into a opportunity fund, that's when you would have to pay taxes on those gains at a, presumably, hopefully a stepped up basis. I think that it's going to stick around for a while. My hope is that we get conscious investors and conscious fund managers increasingly involved in these kinds of projects. I mean, yeah, that's kind of my hope.
David,
I think that's everyone's hope. I think, I agree with you, Patrick. I think that's everyone's hope. And, to me, as more of these transactions get done, you'll see a step up in terms of volume and frequency. So I think that, 2021, we should see continued uptick in these types of deals and transactions on a go-forward basis.
Where are we, would you say, David, in terms of volume now versus like kind of the capacity for where it should be, if you had to kind of approximate it?
I would say there is, to be honest with you, a lot of the investment that has been done in major metropolitan areas have been in those areas where gentrification has occurred. And I think as we look at more, more like the opportunities here in North Carolina, I think where it's more, rules, not the word, right word, but let's say more suburban. I think we'll see increases in on that front as well. Because there is, you can do a lot with that. And I've seen from business clients that have they're looking to move from the downtown area to opportunity zones where they can have their headquarters and they can have, take advantage, have investors come in and provide the capital and take advantage of the tax benefits of the opportunity zone. So I think you're going to see more of that from an economic development play as well. But I agree with Patrick. We do need more conscious capital involved in this as well too, to make sure that we're adhering to the spirit of what the regs were intended to accomplish.
If you could design one thing into it, is there anything you would design into this to like make it so that it could be more, so you don't have to just hope for, people to follow the intent, to where it's more like designed to only have it follow the intent?
I think the best outcome, and there are funds that are taking this approach. The best outcome is to put investment into an opportunity zone that creates jobs for people who live there, to the point that sufficient economic activity supporting those jobs, that the people who are working them don't have to move because their rents are driven up. And that's a problem I don't know that any legislation can solve, but it really would, in my mind, take a multifaceted approach to investing to make sure that the people who this legislation is designed to benefit, i.e. the people who work and live in opportunity zone areas, get the benefit and don't get run out of there.
Or as simple as part of if it's a residential development, a certain percentage of the housing is allocated.
Yeah, that's true.
That have historically lived in that project, so that they're priced at below market rents, so that they have the opportunity to continue to reside in that area as well.
Oh, that's good. Yeah.
Yeah, I think on the one hand, it's easy to sort of jump to the conclusion that this is basically a gentrification accelerator, and so really has no societal benefit other than like increasing property values in otherwise depressed areas and just moving capital around, which is not terrible, I guess. But I think, for me, it just comes down to the businesses. If it's clear and easy for businesses in opportunity zones to meet those safe harbors and raise money and get more money into their businesses, then that will drive a lot of the kind of intended economic activity around the real estate. Like just on the real estate, like that. Yeah. Inevitably after 10 years, then you still got to cash out and they're going to sell it and it's going to be a new condo anyway. So like, it's almost like that's going to happen unless it's a thriving business community and there's other reasons to keep it that still create the win-win-win. I think kind of short term, it's there. Like if you can take a rundown place, make it into a nicer place that encourages more local business activity, foot traffic, et cetera, and those jobs all stay in that area. People can, have a nicer place to work and without moving. I think that's great. And I think that's definitely the intent. I just kind of keep thinking about like, how do we produce more resources? So if you think of stuff, let's share them, let's post them, let's get them on the internet. If I think of stuff, I'll do the same. I think kind of getting more education around the business side will be, to me, a key to kind of maintaining the spirit of the program.
And I think, Nick, an area where this can be applied is, in some kind of public-private partnership where we can do, workforce housing, because part of the issue is that we have a lot of folks that service our communities, right, that can't afford to live there anymore, whether it be our first responders, firemen, policemen, whether it be teachers teachers or, folks that, are garbage men, folks like that can no longer afford to live within our communities and doing projects that they could benefit. And that's something that, because we want those people to be here. We don't want necessarily where they have to commute out from 20, 25 miles out in order to come to do the job here in the city. If we could do something on that front, I think that would be nice, and something to pursue.
That's right. Yeah. Yeah, and all these towns, I mean, we have an office in New Orleans, and I think that's one of their biggest fears there is that it gets so cool that all the locals have to move out because that's literally what makes the city sort of the magic of all these people that live there that have, gone through different things together, but that make, everything from just like the food scene to the art scene, music, um, the voodoo street scene, all that stuff. Like if that all goes away because it's just like super touristy and turns into, I was gonna say turns into Charleston, but I didn't really mean that as a negative. But like, oh, everything's super fancy. It's all tourists, and then every old house is $1 million plus. Then it loses its character and it sort of defeats the whole purpose. And so we don't want that here in our towns either. So I think that's a great idea, David, and would love to put our heads together on how we can make that happen and keep the conversation going. But I know we're a bit over time, so I want to wrap up. Yeah, I think this was super productive. David, I guess you go first. Do you have any kind of closing thoughts or plugs for yourself, the firm, your personal projects, professional projects, or anything of that nature? I would say now would be the time to plug it.
Well, thanks, Nick. I do want to mention that our firm is a certified B Corp firm. That means that we're devoted to our community and giving back to our community, and that our attorneys consider ourselves integral to the community and take a large role, whether it be through our providing pro bono services or participating on boards of particularly of organizations that are of interest to us. That's instilled in each of our attorneys, and we like to see capital done for good as well. Where our firm provides a full suite of corporate law services, whether it be from mergers and acquisitions to commercial real estate to succession and business planning, and we have a statewide platform to do so. I think, as I said, that in terms of opportunity zones, I think this will continue to grow, and we want to make sure that it's done where everyone gets to benefit from it, and it's a win-win situation. Turn it over to Patrick.
Well said, David. I would just say, Nick, going back to something that a comment that you made earlier about, small business owners may not have their network of attorneys and accountants. Well, make us part of your network. We're happy to have a conversation. So we love talking about this stuff, and we love thinking creatively about it. So give us a call, shoot us an email.
Sounds great. Cool. Well, that's it. That's an awesome show, guys. So I'm gonna hit hang up. This, obviously, last piece will get edited out, but like I said, we've got kind of interns on the case, so this isn't going to post like next week. So if anything you think of, you want to add, or add a link, or like, oh shit, I shouldn't have said that, like just whatever. But probably 3 or 4 weeks, you'll get an email from us being like, hey, this is about to go up. And then what are your social handles? So we'll send all that. And I should have thought twice because I obviously am now going to send this to said team, and I should have stopped recording before I said the interns were doing it. Therefore, they're slow. That's not true. They're awesome. Well, as you edit this, do a great job. Make me look good. Go polish my,
you guys rock.
My gray out of my beard. Yeah. But yeah, thanks. That's awesome. I like that kind of that piece about, integral to the community. And I think that's sort of it's whether opportunity zone or businesses at large. And actually all of this is sort of around the virtuous circle of business and community and people, right? So like if we create a better sort of place, then we'll all kind of benefit. And that's, I think, kind of the B Corp mission too. Like it does help your bottom line to also go do free stuff and help advise others and help them get better at their thing, even though it's not a direct benefit. You'll get that direct benefit back later somehow.
Yeah.
So good stuff. All right. Well, I know you guys got to go, but thank you for the time. And
thank you so much, Nick, for the opportunity. Appreciate it.
Yeah, good to talk to you guys,
Nick.
as always. All right. Thanks, David. Thanks, Patrick.
Yeah.